The oil and gas industry says carbon capture, utilization and storage is going to be a crucial tool as we move towards net zero emissions by the middle of the century. We are joined now by an entrepreneur in that space who says we do need to find what he calls the radical middle. In other words, that we need to go on using oil and gas, but we also need to invest heavily in carbon capture. We're joined by Craig Golinowski. He's managing partner at Carbon Infrastructure Partners. Thanks a million for joining us, Craig.
Thank you, Andrew. Nice to be here.
Craig, your career includes investment banking at RBC. You've been involved in extensive private equity investing. You've been around oil and gas for a long time. Tell us what Carbon Infrastructure Partners is.
Yeah, thanks. Well, we're a private equity firm that invests across the carbon life cycle from oil and gas production through to carbon capture and storage. And we're located here in Calgary, and we have a team in the United States.
How much roughly have you invested so far, would you say?
Over the course of the life of our firm, we rebranded ourselves in 2020. But over the life of our firm, we've invested over $1.3 billion into Canadian oil and gas startups.
Right. So, and we'll get into your carbon plans right now. But so you've invested in oil and gas companies in a straightforward way, but also you're putting money into carbon capture now.
That's correct. So we wanted to add a business line dedicated to carbon capture and storage. And to complete the carbon life cycle. So our view is that oil and gas, there's not really an alternative from an energy perspective to using oil and gas. There is an alternative to dumping CO2 emissions into the atmosphere, and that needs to be addressed through carbon capture and storage. So
you espouse something you call the radical middle. You say it's facile to advocate doing away with oil and gas, but you say we do need to capture carbon at the point of production.
Yeah, absolutely. I mean, basically right now there's this sort of binary approach that's, the pension funds, the banks, the financial system in general has signed up to, which is this idea that if we cut off capital to oil and gas, the supply of oil and gas will fall, the price will go up, and that people will then substitute to renewables. And that logic is deeply flawed because renewables are made from fossil fuels. And so, in fact, what's happening is that as the prices of fossil fuels are going parabolic, the cost of renewables are also going up at a very high rate. And at the same time, society's ability to afford to invest in renewables is falling because we're spending more and more on energy. And so the basic construct of cutting off capital for fossil fuels is flawed, and it's not going to work.
When you say renewables are made using hydrocarbons, you mean the steel for wind towers, the energy needed to make solar panels, things like that?
That's correct. So a solar panel is basically made out of coal. A wind turbine is basically made out of coal in order to make the steel. And the copper, the nickel, the various minerals that are needed to create the renewables revolution, are incredibly raw materials intensive. And so what happens is that as we increase the demands on concrete, steel, iron ore, nickel, copper, the amount of those raw materials that we need to replace the same barrel of energy that comes from oil, it's an incredible change. It's more than an order of magnitude in terms of the fact that renewables have less energy density. And so we're in this sort of feedback loop where, the prices of all commodities are basically heading higher, largely because of this flawed idea that we're going to be able to, switch over to renewables and that'll be cheaper.
Tell us, have you made any investments in carbon capture and sequestration yet?
So this is an emerging industry. The commercial model for, putting value on avoided emissions is an emerging industry. So in the United States, the Section 45Q tax credit was just recently put in place. that provides a commercial framework whereby the capital that's invested into carbon capture and storage can generate a return. In Canada, the recent federal government announcement for the investment tax credit for carbon capture is a first step in the right direction. Mm-hmm. And that combined with a guaranteed price on carbon in terms of the federal government underwriting the carbon tax schedule, those two items taken together will create the economic framework to make carbon capture a commercial endeavor in Canada.
So you haven't pulled the trigger yet on an actual investment in carbon capture?
Well, we are working on we are working on several projects at this time, which basically until we get the final policy certainty, it just wouldn't make any sense to hit final investment decision. But today we are invested with a variety of projects where we're doing front end engineering and we're working these projects towards a final investment decision.
It is exciting times, isn't it? Because the oil and gas industry isn't the only emitter of carbon. You're also thinking about fertilizer companies, for example. They use enormous amounts of energy.
That's correct. So as you know, this is one of the unintended consequences of cutting off capital to oil and gas, is that today there's a massive problem in the fertilizer market, and there's an incredible shortage, largely because the Europeans have had to shut in their fertilizer because they're short of natural gas. But carbon capture allows you to produce ammonia fertilizer with nearly zero emissions. And so that's just an example of where carbon capture can create various energy products like ammonia fertilizer and do that with very low emissions. And Canada, in fact, has experience with this. We already have fertilizer units equipped with carbon capture in Western Canada today.
Give us a final thought. The Americans have taken a broadly different approach. They apparently have offered credits per ton of carbon captured. I know I'm grossly simplifying there. Whereas in Canada, you get credits on your investment. Do you think either approach is better?
Well, so they are ultimately needing to get to the same place, which is, to provide a utility-like rate of return on these infrastructure-like assets that are long-term assets in terms of, managing and carbon emissions. And so the model of, how to create a utility-based rate of return can be arrived at in multiple ways. In Canada, because the carbon tax already exists, the federal government elected to, use an investment tax credit model so that the assistance from the feds come up up front, and then the projects rely on the carbon tax going forward in terms of making the economics make sense over time to pay for the operating costs and the return on the capital invested as a whole. The United States has applied a slightly different logic. They don't have a carbon tax at this time, and so their approach is to cover the entirety of the rate of return through the 45Q tax credit.
Craig, thanks very much indeed for joining us.
You're welcome. Thank you.
Craig Golinowski is managing partner at Carbon Infrastructure Partners.